A while ago we chatted about turnover and what it means for your small business. Today we're talking about a much more important term, and that is profit. Hiya folks, welcome back to the Small Business Toolbox. I'm Andy Mack and I've been self-employed for ages and ages. There's a famous expression in the business world, and that is that turnover is vanity, profit is sanity, and cash is reality. As a small business owner, it's really important that you understand how much profit you've made, because ultimately it affects how much tax you're going to have to pay apart from anything else. But you're also going to have to understand all the different terminology that gets used, because as your business grows, you're going to come across different words for profit, and your accountant's going to refer to stuff, and maybe investors might get involved later down the line. They're going to refer to all this different terminology. You need to understand what it all means. Now, don't panic too much in the early stages, because HMRC, the only thing that they care about is, we've talked about this before, two figures, your total turnover and your expenses, and from that they basically deduct your expenses from your turnover and you're left with your profit, and that's what you pay your tax on. But over time that's going to be too simplistic for your business to operate, and you're going to have to delve into things in a little bit more detail, and because of that you're going to have to understand what things like gross profit, net profit, EBITDA, EBIT, operating profit, COGS. You need to understand what all that stuff means. So first of all, gross profit. That's your easy one. The gross profit is literally your turnover minus your cost of sales. So I briefly mentioned COGS earlier. COGS is cost of goods sold, and it's just literally your direct costs. So say, for example, I always use the analogy of like a t-shirt business where you might get t-shirts printed and then you sell them to customers. Your COGS would be the bare material costs of the t-shirts themselves before you sell them. There are various methodologies used for assessing what your cost of sales are. For example, is it literally just the material cost of the t-shirt, or are we also going to account for things like staff who do the printing of your t-shirts? If you've got a member of staff who their sole purpose in life is to print your t-shirts for you, then is that a direct cost of the sale? I'm not going to go into that in too much detail in this video because it'll end up being 3 hours long. I'm just going to assume your cost of sales is your raw material costs of the t-shirt. You've then got your operating profit, and your operating profit is your gross profit minus your operating expenses. So that could be anything from like your general bills and utility bills and running a vehicle and stuff like that, through to, as I say, staffing costs and other such expenses, general operational expenses for your business. It's the kind of expenses that would exist regardless of how many t-shirts you've sold. So your cost of sales is going to go up depending on how many t-shirts you sell, but your operational expenses are probably going to stay more or less the same. I mean, yeah, obviously if you get bigger premises or you take on more staff, they're going to go up, but it's not directly proportional to how many t-shirts you've sold. And then finally, for now, you've got your net profit. Your net profit is your important one because that's kind of your final amount of money that you're left with, and it is your operating profit minus any interest you have to pay and minus taxes as well. But as briefly mentioned earlier, you are going to come across other terminology such as EBIT and EBITDA. EBIT or EBIT is earnings before interest and taxes, and EBITDA or EBITDA is earnings before interest, taxes, depreciation and amortization. It'll be easier for me to explain this if we head over to the computer, but I'm going to use the analogy of a t-shirt shop. Two t-shirt shops, in fact. So imagine we've got a t-shirt printing business, and this particular t-shirt printing business, it's called T-Shirt Express, and they do all of their production in-house. So basically what they do is they buy up blank t-shirts, and it costs them £2 per t-shirt, and then they've got all the equipment to print them up and whatnot, and then they sell the printed t-shirts for £10 each to the public. And just for simplicity, we're going to say they've bought 10,000 of them. So they've bought 10,000 and they've sold 10,000, just to keep things simple. Well, first of all, we know that their turnover would be £100,000, which is the £10 times the 10,000. And the cost of sales would be £20,000, which is the £2 times 10,000. So that's their COGS basically. Now, obviously, they're going to have some operating expenses to keep the business running. So we're going to say they've got £10,000 worth of general operational expenses, and they've also had to buy some machinery to do the actual t-shirt printing, and we're going to say that that machinery costs them £50,000. The operational expenses are just like day-to-day bills, day-to-day running costs of the business, gas, electric, and all that sort of thing. So if we were running on the cash basis, then their cash basis profit would be £20,000. So we've got £80,000 worth of costs, £100,000 worth of turnover, and that leaves £20,000 profit. Now, we've touched on this before, but cash basis isn't really designed for big businesses. It's designed for very, very small businesses, and it's designed to keep things simple while you get things off the ground. So cash basis has a maximum turnover of £150,000, and it also has a maximum interest amount that you can claim if you're paying interest on loans and things like that. Maximum interest amount of £500. At the moment, we haven't really talked about interest that much, but we'll talk about that in a minute. We're okay on the turnover front at the moment, 100,000, but you could certainly see as the business grows, we could easily go past that, and that's why we need to start catering for moving on to accruals-based accounting, and why other profit terminology will start getting used over time. So for now, we're just going to ignore the cash basis figure. So let's assume they've had to get a loan to pay for this machinery. So obviously the machinery's a one-off purchase, but the interest on the loan they're probably going to be paying every year or every month or whatever. We're going to assume all of these figures are per year, but obviously the machinery cost is just one-off. Now, once you move on to proper accruals-based accounting, you're no longer going to be accounting for the £50,000 all in one go. You're going to be depreciating that over a period of time. And this is where depreciation and amortization comes in. I'm going to pop a figure of £5,000 for depreciation in there. All the depreciation figure is, don't overthink it. It's just a way of accounting for the cost of that item over the useful lifespan of that item. So if we say that that item has a useful lifespan of, say, 10 years, then it would be reasonable to say that we can depreciate it at £5,000 per year, because over 10 years that would cover the £50,000 cost. That kind of assumes that we're doing straight line depreciation. There's a couple of different ways of doing depreciation. I'm not going to cover that in this video. We're just going to keep it really simple. Now, what is amortization, I hear you asking? Well, amortization, why they have it as two separate words, I've got no idea. It's exactly the same as depreciation, but it's for non-physical items. Depreciation is for stuff that you can touch and feel. It's for tangible assets. Amortization is for non-tangible assets. So what sort of things would that be? Well, it could be like patents and copyrights, trademarks, franchise agreements. All of that sort of stuff comes under amortization because it's not a physical thing that you can touch, but it still has a value at the point that you purchase. Say, for example, you purchase a trademark. The cost of that trademark can be set off over a period of time, and that gets called amortization. So as I say, we're going to just depreciate that at £5,000 per year over 10 years. So for the purpose of the accounts, we've got £5,000 of depreciation, and we've got the £5,000 of loan interest. So first of all, gross profit. What do you think the gross profit would be? It's simply the turnover minus the cost of sales. So the direct costs of the blank t-shirts is 20 grand, deduct it from that, and we've got a gross profit of £80,000. Now, your operating profit is your gross profit minus your operating expenses, so minus your business running costs. And in this case, your business running costs are going to be your operating expenses up here. We're not going to count for all of the machinery, but we're going to count for the depreciation amount. So we're going to take off the £5,000 for depreciation, and that leaves £65,000 of operating profit. We're not catering for the loan interest at this point. Now, in order to work out how much tax you're going to have to pay, and I'm going to keep this really simple and just keep it at 20%, but you need to know what your pre-tax profit is first. So your pre-tax profit is going to take into account the loan interest, so we're going to deduct this £5,000 here, but that's not part of your operating profit. So we're going to take that off as your pre-tax profit, and then we basically do 20% of that, which leaves a tax bill of £12,000. And then obviously once we deduct the 12,000 from the 60,000, that leaves a net profit of £48,000. But that still doesn't paint the whole picture. And that's where EBIT and EBITDA come in. So let me just put a little reminder in this column here. Loan interest, I'm going to put an I here so we remember that I is for interest. Depreciation and amortization, I'm going to put DA in there so you remember that DA is depreciation and amortization. And here we've got tax, I'm just going to put a T for tax. You can see where we're going with this because of course EBITDA is earnings before interest, tax, depreciation and amortization, and EBIT is just earnings before interest and tax. So it gives you another way of assessing the performance of the business that isn't catered by looking at your gross profit, operating profit or net profit. To be fair, your EBIT is almost certainly the same as your operating profit. But even that can vary depending on where you are in the world or what accountant you speak to. But for argument's sake, we're going to say that EBIT is the same as operating profit. In order to explain why these extra metrics are useful to have, let me show you another t-shirt shop. So here's our competing t-shirt shop over here. It's called T-Shirts For You. And this shop, instead of producing the t-shirts themselves, they outsource all of the printing and whatnot to another company, probably a company similar to T-Shirt Express. So because of that, their cost price is slightly higher. So the cost price, we'll say, is £4 per t-shirt instead of £2 per t-shirt. They're still going to sell them for £10 each, and we're still going to be basing it on 10,000 of them. So the turnover is still £100,000, exactly the same as before, but the cost of sales now is £40,000 instead of £20,000. But to keep things simple, we're going to say that operating expenses are nil because they're going to literally outsource all of the production. It's probably a little bit unfair that they're going to have some operating expenses, but it's just to show you how this works. And the machinery costs are going to be nil because they haven't bought a machine to do it themselves. So in this scenario, if they're on the cash basis, their cash basis profit is now £60,000, which is simply the 100,000 minus the 40,000. Again, we're going to ignore that for now because it's just going to complicate matters. They're going to have no loan interest. They're going to have no depreciation. So those are both zero. Their gross profit is the same as the cash basis profit that we mentioned earlier, which is literally the turnover minus cost of sales, which is 60 grand. The operating profit is the same because we've said they've got no operating expenses. As I say, a little bit unfair, but it's just to keep it simple. And all of that means they've got a pre-tax profit of 60 grand, tax at 20% is 12 grand, and they've got a net profit of £48,000, exactly the same as the other t-shirt company. But obviously our cost of sales is much higher. In fact, our cost of sales is double what we were paying at the other company. So if you were to just look at the net profit figure or even the pre-tax profit figure, it looks like these companies are exactly the same. It looks like they perform in the same way, but clearly that's not the case. And that becomes more obvious once you start to ramp up the quantity of t-shirts being sold, and I'll show you that in a minute. But if we take into account EBITDA and EBIT, then that's where the full story starts to become a bit more apparent, because EBITDA takes into account the earnings of the business but ignores the interest, taxes, depreciation and amortization. So you can see straight away by looking at the EBITDA for business number one here, it's £70,000 versus £60,000 for this other business, because ultimately the first business is a more profitable business. And as I say, that becomes really apparent once we start to ramp up the quantities being sold. So just have a look at the net profit figure down the bottom here. If we change this to 20,000 instead for both businesses, straight away you can see the net profit of business number one here is now £112,000 versus just £96,000 for business number two. If we increase it again to 40,000 t-shirts, you can see we've got a net profit figure of 240,000 versus 192,000. That's really good. But look at the EBITDA figure. The EBITDA of business number one is £310,000 versus just £240,000 of business number two. of the company doing the outsourced production. And over time, when you're looking at management accounts, and management accounts are kind of internal accounts that you would do for your own business to track the performance of the business that don't necessarily get handed over to HMRC or whatever, but the management accounts that you look at from month to month to see how the business is doing, and that's part of the job of a finance team, will be analysing things like your EBIT and your EBITDA and looking at how that compares to things like your gross profit and overall profit margin and profitability of the business. And it can paint a whole different picture of the performance of the business. And that's why looking at just gross profit and net profit sometimes isn't the best approach. And that's why these extra figures come into play as your business grows. As I say, when your business is small, don't worry about it at all, but it's useful to know what the terminology means. So to summarise, looking at all of these metrics from your easiest to work out, which is your turnover, all the way to the hardest thing to work out, which is your net profit, you've got pros and cons to all of these. So for example, turnover, it's very easy to calculate and it's a good kind of vanity performance indicator, but it certainly doesn't tell you very much about how profitable your business is. In fact, it doesn't tell you anything about how profitable your business is. You could be selling 1 million t-shirts at £2 each. You would have a £2 million turnover, but you've literally made no money whatsoever. You might as well have just sat in a room doing nothing because you've made the same amount of money in the long run. So as I say, the big downsides of using turnover as a metric is that you've got no profit information whatsoever. It could be a loss-making business. Although to be fair on using turnover as a metric, if you know what your overall profitability always is, so say for example you know that you're always going to be about 50% profitable, so no matter what your turnover is, your costs are going to be about 50%, then you can take a rough guess that if you've made £2 million turnover, you've probably had £1 million costs, and therefore you've had a £1 million profit. So you can use it as a very, very rough gauge, but to anyone outside the business, it's more or less meaningless. Gross profit is really good for telling you how profitable your business is at a product level. So having the ability to sell very profitable products is obviously a very good thing, and gross profit will tell you how good your business is at doing that. But obviously it doesn't cater for the business running costs. The cash basis profit is fine for very small businesses, but again, it doesn't tell you the whole picture at all. It doesn't describe the actual business performance properly because it doesn't really take into account things like depreciation over a period of time. Cash basis can actually make it look like your business is very, very loss-making for a particular year, but if you've just bought a really big bit of equipment that's going to last you for 10 years, then all of your following years are going to end up looking overly profitable. Because your following years aren't taking into account the cost of the equipment if you've catered for all of that in the first year. EBITDA, which is your earnings before interest, taxes, depreciation and amortization, really good for measuring cash flow of your business. It's very good for companies with high capital costs because it doesn't cater for those capital costs because it tells you the earnings before those capital costs have been considered. And it's a good measure of the earning potential of the business. We're basically saying if it wasn't for all the money you've had to spend on equipment, this is how profitable your business would be. But as I say, the downside of that is that it doesn't cater for capital cost and it doesn't cater for your financing or taxes either. EBIT is getting closer to your net profit because it does cater for your capital costs, but it still doesn't cater for your financing or tax costs. And then of course net profit is probably the most important metric of all, but it is also the hardest one to calculate, and even that can't be viewed in isolation as your business grows. You need to have a good idea of all of these metrics, and you need to work it out for your particular industry, your type of business, which metrics are the most meaningful to compare from month to month or from year to year to paint a picture of your business performance. The big problems with net profit, of course, is that it may be influenced by things like asset sales. So if you've sold the equipment that you've bought to make your t-shirts, that'll make your net profit look higher, but you can't make any more t-shirts because you've sold the equipment. So having a high net profit isn't necessarily a good thing if you've been selling assets to generate a higher net profit. As I say, it just doesn't tell the full story, and every metric needs to be understood
for your particular type of business.
Just to complicate matters slightly, HMRC refer to net profit as a kind of pre-tax profit, whereas generally speaking, outside the world of HMRC, net profit is generally after tax. The key thing to remember though is that this sort of terminology can be used to assess the performance of your business over time. So you would very rarely talk about your EBIT or EBITDA for a single year, but it's when you start comparing it either from month to month or from year to year that it becomes a much more useful indicator of your business performance. Which metric you use is entirely down to you, and it's down to the type of business you've got as well. As your business grows, obviously this can get quite complicated, and it's why it's so important to have an accountant, because an accountant will have a much better idea of what's going on with the detail of your business than anyone else. So as I've always said, get a good accountant. I hope that all makes sense. If you've got any questions at all, pop them in the comments below. If you're an accountant, let us know the sort of terminology that you prefer to use with your clients. I've heard of some accountants who do refer to EBIT and EBITDA, and I've heard of others who just literally never ever talk about it. It's certainly not something that I would expect a very small business to keep track of, but certainly as your business grows, you are going to run into situations where people are going to start talking about this, and you need to understand what it means. I'll include some links in the description below of where you can buy these t-shirts from if you want to pick one up from my Gosforth Handyman shop. I'll pop a copy of the spreadsheet that I was showing you before. I'll pop that onto the members area of the Small Business Toolbox website. Remember, you can now join the Small Business Toolbox website and you can get access to extra downloadable content, and it's also direct support for this channel, and it helps me to make more videos like this. So if you found my content useful, it would be awesome to have you on board as a member over there. For now, folks, best of luck on your small business journey. Take care, and I shall see you next time. Tatty bye.